welcome to Entrepreneurship to the Point. My name is Nomazizi Poto, and today we're talking financial management. A lot of business owners shy away from it because they would rather do other important things, such as business development, and they would rather leave all the financial managers to the accountant or the bookkeeper. In today's video, we're going to talk about the following topics. 1. What is financial management? 2. The components of financial management. 3. Budgeting or planning. 4. Bookkeeping. 5. Projections, the importance of maintaining healthy cash flows in your business. 6. Financial statements, the reporting and the analysis. Last but certainly not least, applying for funding. Financial management is a function in a business that is concerned with profitability, expenses, cash and credit so that the business can carry out its objectives as satisfactorily as possible. It gives you the tools to plan for overall business growth, for diversification of your service lines, or to expand into new markets. This is just a snapshot of what financial management is, and we will take a deep dive later on the video on other components of financial management. Financial management comprises of 5 main components, namely budgeting, bookkeeping, projections, financial statements, and business finance. Before we unpack all these components, I'd like to take you through why each and every one of these components are important and cannot be looked at in isolation. The components of financial management are important and may not be looked at in isolation, as mentioned previously. In the absence of any one component, one will not be able to plan, analyze, and report. This poses a threat on the accuracy of the financial statements, and this means that the business's financial information or annual financial statements cannot be relied upon. Planning and budgeting is pivotal for the success of any business. It allows businesses to determine whether their plans are smart. When budgeting, the business is able to project and estimate the requirement of funds in the short, medium, and the long term. Budgeting also allows the business to look back and track variances between the budgeted and actual figures, and this influences decision making. Bookkeeping. This function may be carried out by a bookkeeper or an accountant. It is vital for the business to track its income and expenditure on a periodic basis so as to make necessary changes to its budget. This component is critical for the financial success of the business, but it may seem like a daunting task because not every entrepreneur is a bean counter or they're financially inclined. And also, businesses may not necessarily be able to afford to hire a full-time accountant or bookkeeper. These types of entrepreneurs may consider taking the following steps in making sure that their financial affairs are in order. Number 1, obtain a cloud-based accounting software. 2, open a business bank account. 3, track your invoices. 4, draw up an income statement before drawing a salary. 5, pay business expenses before drawing a salary. 6, keep your personal and business expenditures separate. Let's talk about cash flow projections. So these can be best described as a breakdown of future economic inflows and outflows in an organization. Why is this important, you may ask? This is a goal-setting tool and is largely used to demonstrate the commercial viability of your business to potential investors and financiers. Financial statements comprise of 4 main components. Number 1, a balance sheet, which is also known as a statement of financial position. Secondly, an income statement, which is better known as the statement of comprehensive income. Thirdly, the statement of changes in equity, as well as the cash flow statement. I'll go ahead and explain these 4 components to you of the financial statements, starting with the income statement. An income statement is one of the tools that assist entrepreneurs to understand the financial health of the business. An income statement gives you a picture of what the drivers of the company's profitability are. And this information can help the business owners to make timely decisions that make sure that the business is on a good financial footing. A basic formula of the income statement can be described as sales or revenue less your cost of sales, less your expenses, and this will result in either a profit or a loss for the business. A balance sheet is used to show the financial position of a company at any given point. It comprises of 1, assets, secondly, liabilities, and thirdly, equity, owner's equity. The basic formula for a balance sheet can be described as assets equals liabilities and owner's equity. The difference between assets and liabilities is essentially what will give you owner's equity. It also shows how assets were financed. Assets can either be financed by debt, and in this case, they will be disclosed under the line item liabilities. If the assets were financed by the entrepreneurs themselves, this will be disclosed as a line item under owner's equity. Assets can be financed by either debt or the entrepreneur. If financed by debt, it must be disclosed as a line item under liabilities. If the assets were financed by the entrepreneurs, it will be disclosed as a line item under owner's equity. Cash flow statements. This tool in financial management is used to analyze the cash inflows and cash outflows of the business. It shows you how changes in the balance sheet and the income statement affect your bank account at the end of the day. The cash flow statement comprises of 3 main components. 1, cash from operating activities. 2, cash from investing activities. 3, cash from financing activities. Simply put, the statement of cash flows provides information about the organization's liquidity. And what is liquidity? Liquidity is the ability for the businesses to pay its expenses as they fall due. It also provides information about the company's solvency. Solvency is whether the business has more assets than liabilities, and whether the organization has wiggle room and is able to increase its cash reserves. Once your financial statements are in place, a deeper analysis on the financial health of the business can be done through ratio analysis. There are 4 main groups of ratios a company should perform on an annual basis or even on a quarterly basis. The first one being liquidity ratio, which is used to determine if the business can meet its obligations as they fall due. Secondly, the solvency ratio, which is used to determine the proportion of debt to equity in financing the business assets. Thirdly, activity ratios, which reflect the organization's efficiency in utilizing assets. Last but not least, the profitability ratios, which measure the overall performance of the company, and that is important for all internal and external stakeholders of the business. Business financing. There's nobility in finance and you have to live up to it. You can't avoid it. Every businessman and woman has to be financially literate. There are 2 main things that we are confused about as society in general when it comes to financial management. That is borrowing and debt. Some people think debt is bad, but it is wonderful. Debt is fantastic because you can access opportunities you couldn't access otherwise. If you want to live in a house you can't afford to buy cash, what do? You take up a mortgage bond. If you want to invest in education, what do you do when you don't have the resources? You take up a student loan. Debt can be liberating, but at times we do not understand the disadvantages that go along with that. There are mainly 5 types of funding which businesses can access, namely funding from development funding institutions. Secondly, grant funding. Thirdly, a business can approach a commercial bank for finance. Fourthly, equity funding. Last but not least, venture capital funding, which is funding for high growth and scalable businesses. Funding is important for a business to get off the ground and to expand. The process of getting a business off the ground can be challenging, and to keep it moving in the right direction is even more difficult. The global economy is constantly changing, and businesses must follow the markets and be prepared for accessing funding opportunities. In developing a business plan, Managing cash flows may not be adequate. Expansion may require additional financing. If a business does not have enough cash reserves, it will be compelled to solicit funding from external financiers. As a starting point, applicants need to have a comprehensive business plan, which tells the funder what the funding need is and should be able to demonstrate that there is a need for its service and/or products in the market. This tells the funder the gap that the applicant is trying to address, and it further states how the entrepreneur is planning to address that gap. The business plan needs to tell the funder that they are banking on a viable and sustainable business that is going to grow its economic participation and create jobs. If there are gaps in the business plan, the funder may ask the applicant to address such gaps. Most funders have business support programs which are intended to assist businesses to become funding ready if they're not. But the funder has to be satisfied that the investment into the applicant's business is viable, as the business support program comes at a cost to the funder. Most funders require similar documents from applicants when applying for funding. Most common of these documents are your business plan, which should have financial projections. They require contracts, service level agreements, off-take agreements if you are a startup. They require a past order book if you are an existing business. They require a loan application form, which obviously differs from funder to funder. They require a BE certificate showing a level 1 or 2 status. They require your company registration documents from the CIPC. They require a tax clearance certificate or a PIN. They require annual financial statements. 3-year historical statements normally do the trick, but over and above that, you need to submit your latest management accounts. Stamped business statements, minimum 6 months. IDs or identity documents of all directors and shareholders. They require a resolution authorizing borrowing powers. They require surety or any form of security with supporting documents. They require any regulatory industry licenses where applicable. Proof of address for all owners for FICA purposes. They require a path to job creation, where you predict the number of permanent jobs that you intend to create in the next 2 years.